All right. Hello, everyone. Welcome to our financial workshop on investing for beginners. I'm Chelsea Newton with Spero Financial, and I'm really glad that you're joining us this afternoon. Just a few notes before we get started. As you just probably heard, we are recording today's session. Your microphone should be muted, but just make sure that they stay muted until the end of the presentation. We're going to have a little Q&A. So just hold your questions till the end. I want to introduce you to a friend of mine. This is Micah Valentine. He's the founder of Pinnacle Wealth Management right here in the upstate. At Spero Financial, we're dedicated to helping our members achieve financial goals, and that's why we recommend the specialized guidance of our friends at Pinnacle Wealth Management. Micah brings a wealth of knowledge and years of experience. Like I said, I truly enjoy working with him and catching up with him before these workshops. He has a genuine passion for guiding people towards their long-term financial goals and keeping us informed on the hottest topics. So, Micah, the floor is yours.
Great. Thank you so much, Chelsea. Appreciate the very nice introduction and for hosting and for pulling this all together. I know it's a lot of work, so that doesn't go unnoticed. Thank you guys, everybody, for being here this morning. Well, you're right, this afternoon by a few minutes. Today's topic we're going to be talking about is calm, cool, and invested. Staying on track to live the life you want. Okay, that's a nice topic. What does that mean? So we'll jump right into it. Put it down here. So this presentation is some materials from our partners over at MFS, Massachusetts Financial Securities. They are the first company to create the very first mutual fund ever back in 1924. And years ago, I was in Boston where they're headquartered, and I went up to the top of their tall building and I saw inside a glass box a very old piece of paper with written down was the very first mutual fund ever. So, and that fund is still in existence today. So, pretty cool thing to see. But they've got a lot of great material out there. So, we like to partner with our partners and use some of their stuff. So, again, that's a bit about them. So, we'll go on to the next piece here. So, some common questions about investing. How much do I need? Is it too late to start investing? What if I pick the wrong investments? Do I know enough to make these important decisions? They're all good questions. Well, there's good news. You don't have to. You don't have to have all the answers. The key is to ask for help when you need it. And what I would say is sooner rather than later is the key there. Think about it this way. If you feel sick, you go to the doctor. When you buy a house, you have a lawyer to review your paperwork. We have habits of reaching out to professionals when something's very important to us or where we need some expert advice. So I always say, why then wouldn't you reach out to a financial professional that does this for a living, especially something so important as your future financial well being? And a lot of times it doesn't happen. Unfortunately, we do statistically, Americans particularly spend more time planning for a vacation than they do for retirement. So, gotta keep that in mind. So, let's go ahead and jump on down here and let's talk about what it means to actually partner with a financial professional. Go on to the next slide. So, in getting started with a financial professional, it's really not that hard. Really, it's just having a conversation. That's what I was just telling somebody this morning. I had an intern in here this morning with us and sat in one of our client meetings, and he sat through the meeting. And literally, when he left, the question was, "Wow, I mean, you really just talk about non-money stuff for the majority of the time." And you're right, because really, it's about life and life experiences and life goals and kind of talking about that. What are my goals? What is the financial professional doing those roles? Staying ahead of inflation, finding the right allocation, staying the course, strategy. There's a lot of words out there, but what's that really mean? When you meet with a financial professional, you want someone that's going to listen to you and ask questions back and really kind of gauge to see what's important to you. What are your specific goals? What do you want to do in the future? When do you want to do them? And then you kind of develop a strategy around that. And really, when you're meeting with a financial professional, it's someone you're going to feel comfortable with, that is asking you those questions, and is not just talking all the time. And unfortunately, I'm in this industry now for 16 years, and unfortunately, a lot of folks in my profession, and I've been known to do it in the past, do like to do a lot more talking than listening. So try to slow that down and do more listening. So, what is a financial strategy? It's a summary of your life goals. We kind of talked about that, or a blueprint of how to financially pursue those goals. Your investment professional will provide guidance, hopefully, some techniques that'll help you pursue those strategies. Let's start by talking about one of those strategies, and it's called the power of compounding. What does that mean? Okay, so the time value of money, despite the technical looking slide you see here before you, the concept of compounding is actually very simple. Think of it like a snowball. If you guys have ever been out, played in the snow, got a snowball, rolled it up or down a hill, up and down a hill, and as it gets going, it gets bigger and bigger and bigger because it accumulates more and more and more. And again, the ball gets just to grow. So we kind of look at that from a perspective of the same way when we're looking at saving for the future, for whatever your goals are, whether it's retirement, whether it's to go on a trip, whether it's to pay a house off or some debts off, to pass on to loved ones. I mean, again, every goal is different. So what you see here is there's the hypothetical $10,000 investment, and what it does, it looks back at a history of 40 years. Okay, so you have $10,000, and you're looking at different rates of return. If you had a 3% rate every year, 5%, 6%, and it kind of shows you what that would go to over the next 40 years. Again, so, and we'll get into more about the rate of returns and how to what we call diversify your money in just a bit. But again, the more conservative options are going to be 3% growth. Typically, again, these are all hypotheticals, they're industry averages. There's nothing guaranteed, there's nothing promised. It's just kind of industry. Moderate's going to be 5%. Again, more of an aggressive growth, you can add maybe 6%. Now, there's obviously investments and returns that are quite a bit higher than that at certain times and over time, and there's stuff that are lower. But again, we're looking at averages because that's kind of what we're looking at here. And you can kind of see what we're looking at is it's very, very important from the money side of things is to have your money working, but also saving at the same time. So you're getting that rate of return and you're saving. We can go on to the next slide. Because the reason why it's important to grow your money is you always need your money growing is one of the major things I think a lot of us have felt the last few years, particularly as inflation. And now I'm 47. I know there's some people that are a little bit older than me out here, maybe on the meeting, and there's people that are younger. And this is a look back at 1970 to 2024. Now I was born in 78, so this would have been 8 years before me. A gallon of gas then was 40 cents. Now the average as the end of 2024 was 3.15. So that's a 688% growth. And then milk 132 to 410, 211%. And then public college tuition 1970 was $351, which is insane to me. And they're saying it's $11,610 now, but I can tell you I've got a kid in college now, and I have another one next year, so I have two in college. It's a lot higher than that $11,610. And that's a 3,208% increase. So the bottom line is you need your money growing because inflation is going to continue. So what $1 million may look great and sound great today, but what is $1 million going to buy you in 30 years from now, 20 years from now? I mean, is it going to be enough to live on and to get through your retirement years without outliving your money? Or are you going to run out of money? Again, time is your friend when it comes to financial strategies. And getting back to our financial strategies, the next important step is creating a plan and how to choose the investments. So if we go to the next slide, when you're looking at 401ks or IRAs or anything of that nature, we're talking about choosing investments. Once you're a financial professional and they have this ADR: allocate, diversify, and rebalance. And that's kind of a good rule of thumb across any aspect, whether you're working with a financial professional or you're doing it on your own through your 401k, or you have different other investments you're working on your own. Once your financial professional puts numbers behind your goals, and I would tell you, any financial professional you're working with, having a plan is the key. Anybody can go out and buy and sell a stock or a bond or a mutual fund, especially today's world with the internet and all the online resources. But the key is to pull all those tools together, like we talked about, in creating a plan and making sure you're on track and you're looking at it on a regular basis. But once you have these numbers behind you, say you want to retire at like 65 and you need $10,000 a month in income in retirement, you kind of look at that. Okay, now I'm saving this. How much do I need to put away? Now, we've got tools and resources, a lot of financial professionals do, that will, you can do calculations to figure out if you're going to have enough to retire on, or if you need to save more. But the sooner you catch that, the better. So we're not 5 years from retirement and then saying, oh no, I've got a shortfall and I need to save $10,000 a month. Whereas maybe 20 years out from retirement and we can add an extra $200 or $300 a month to your 401k or whatever that may be. But again, it's good to, like I said, look at that and get a big holistic plan in place. And that's where, when you're investing, you come to the ADRs again. You want to allocate your money to the appropriate investments that you're looking at. You want to diversify them into different categories and rebalance. I think rebalance is one of those things that's overlooked a lot of times, meaning you put money into a 401k, say you want to have a certain percentage of it in the stock market, some of it not. Well, if the stock market goes up a lot over that year, your percentage that you wanted in the stock market, or whatever funds they may be, is usually a higher number than you're comfortable with or you need to have. And then when the market goes down again, you're going to pull back and get hit a lot harder. So it's good to take those gains. There's a whole about a phrase that I'm sure you guys have heard of, even if you haven't been in this financial business. It's buy low, sell high. It's kind of like the philosophy of clipping your gains and reallocating them and putting them in other areas to get better profits. We can go on to the next slide, where it's to allocate, choosing the investments that make sense. And again, this is a look back from $1 invested from 1978 to the end of 2024. And it shows if you put $1 in 1978, January 1978, that dollar would be worth 508 annual return, 3.52. Again, with the cash, literally just well, sorry, that was a consumer price index. Cash, the annual returns 436.74. Bonds 1838. Again, if you see a S&P 500, $1 invested would have grown to $216.74. That's a 12% annual rate of return. So that's why I say it's very, very important to have a diversified, meaning funds in each of these categories, and rebalancing them. So, like, say you've got a big growth in the markets, maybe you're taking those and putting them down in bonds and stuff. So, again, this is something where you can really work with a financial professional on your own, or to find someone, or we're obviously glad to have conversations with any of the members and folks with Spero Financial in that network. So, but again, having them help create an asset allocation, a strategy, a term, looking at your 401ks, because they all kind of come in together. Now let's run down to the next slide. This is a slide that kind of gets people like, what am I looking at here? So a lot of people refer to this as just a sector in chart by year. Some people call it a jelly bean chart. What I tell you is, if you turned this and looked at it long ways, like kind of like if you're looking at the top view from the sky at a fairway on a golf course, right? That's what we're kind of looking down at. If you can see, there's different years. If you look at, I'll zoom in on mine. So if you look at 2015, the number one growth area was large cap growth, meaning stocks. Now that next year, it was on the bottom, closer to the bottom part. Or you can look at a good example is 2017. Cash was the worst performing sector, 2016 and 2017. the yellow box. And you saw 2018, it shot up to the first. The goal here is with anything, if you look right down the middle, you kind of see besides one or two, the gray boxes is what I want you to focus on. It's diversified. It's kind of right down the middle. For the golfers out there, I would tell you it's when you're golfing, and I don't do this at all because I'm a terrible golfer, but you're trying to hit the ball down the middle of the fairway. So that's what our goal is when we talk with folks is we like to have a diversified portfolio, meaning with your either your 401k, your IRAs, your investments, and you have it well balanced. So we're not trying to knock it out of the ballpark one year, but we're not trying to tank the next year. So we're trying to create a good balance and buffer. Again, this works very well with overall plans. Again, this is something, again, not a one size fits all, but again, a good rule of thumb. You can move down to the next slide. Now there's a chart key here. It goes over a couple of terms of cash, bonds, global bonds, diversified portfolio, large cap, commodities, blah, 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 blah. So a bunch of all these are different investment categories that you can invest in. Now, right now, you've got the U.S. Treasury bills they're very short term. U.S. Federal Reserves. You got bonds, which are just that. They're bonds that you're buying. You get bond funds, and you've got the Bloomberg's again. So a bunch of different investment categories you can look at and have your monies in. But again, when we talk about diversified, it's to have it kind of spread out and move throughout a lot of those different categories. And a lot of your 401ks offer a lot of these strategies through either a target date fund or an asset allocation fund. Again, if you have the resources to talk to somebody at a 401k or a financial professional, we're glad to talk with you and look at that with you and see how that factors in to what you're doing. You can go to the next slide. Rebalance to maintain your portfolio's desired allocation. I kind of alluded to this a little bit earlier. I kind of got ahead of myself when I talked about, okay, this is from January 2015 to the end of last year. The stocks outperform bonds. So you see the original, if you started out and you put all your money in January 1st and you had, I want to have half in bonds and half in stocks. So stocks are a little more aggressive, bonds are more conservative. Well, what's happened, obviously, over time, now you've seen the growth of the stocks has grown to 75%. And with the rate increases, bonds values have decreased. So where you originally started with the 50-50, now if you didn't do anything, there was no rebalancing or anything, now you've got 75% in the market, 25% in bonds. Now, what if you didn't want to have that much risk? What if the market just plummets? Okay. And you're going to have a pullback on 75% of your portfolio. So that's why I say every year at least is a good time to look at doing this with your 401k, with your other investments you have outside of your 401k or Roth or whatever that may be. Again, why I keep coming back again. So the rebalance option is very, very important. I know there's a lot of automatic rebalance options that you can select with your 401ks. And if you want some guidance on how to do that, please reach out to us. We're happy to get in there with you to look at your 401ks and give you some suggestions or some thoughts on that. So coming on down to the next slide, our key points here is market performance, stocks outperform, and 3, rebalance. So the relevant market performance of asset classes shifts over time, which may alter portfolio mix investments. Stocks outperform bonds, your allocation to growth stocks. Again, a lot of this is, I don't like the writing of this, how to write it. The bottom line is market performance is important. Stocks will outperform over time over other investments. So you need to take some risk if you're looking at growing your money. And we looked back earlier that we saw that inflation number. That's what I'll tell you, cash and cash alternatives, CDs, money markets, they're not going to be enough to get you the growth you need, more than likely to have your money last year in retirement. Again, that's a rule of thumb. It's not a guarantee. It's not a one size fits all. It's a pretty good thought across the board. But some key points to remember: market performance, the relative market performance of asset classes, it shifts over time, like we talked about. If you remember in 2022, was a rough year. Okay, we just came post COVID. We saw the dip down in COVID, came back up. But what happened was the stock market went way down. Then the Federal Reserve skyrocketed and they rose interest rates a lot. So people were putting money into bonds or bond funds for safety. What happens is the way bonds work, they're kind of like I liken bonds, like if you ever remember, maybe I'm dating myself, on a playground, they have this thing called a teeter totter. So one person will get on one side, one gets on the other, and then you go up and down, but they're opposite. So when interest rates go up, bond prices come down. It's not a matter of if, it does. So when we have interest rates shoot up like they did in 2022, people run into bonds for safety and they got hammered and there was no safe place to put money. So that's why 2022 was a bad year. But again, by having a rebalanced portfolio, you aren't overexposed in one area. You're still going to take a hit in certain years, but it's good to have that kind of mixed across. Um, Again, and if you're selling and say you have a 75% stock portfolio and you wanted 50% because it's grown, if you sell off that 25 and you put it back into the bonds, technically you're buying those bonds theoretically at a lower rate. So when the bonds go up, you're going to have growth. Again, these are things to look at with a financial professional. I don't want to get too into the weeds with it. Um, so, but again, rebalancing, diversifying, allocation, these are all very, very important things. And again, don't have a good handle on it or want some more information about it, please reach out to us or a financial professional. Glad to help. Now we can go to the next slide, Chelsea. Staying calm, cool, and invested. Okay, this is the growth of $10,000 in the S&P 500, 30 years and ending December 31st. So I like this piece right here. So there's a lot of times when the markets decline and people want to jump out. I've been doing this 16 years, so markets just go crazy. Even at the beginning of this year when things went crazy, maybe one political person didn't get voted that you wanted in, or the other one, I get calls and vice versa. But things happen in the markets, so people will jump out. And our advice is stay invested. So if we look back and you had $10,000 30 years ago, okay, and you missed the 30 best days of the market return over that period of time, then your 30,000 grew to 38,115. If you missed the 20 best days, uh, then you were at 60,000. 10 best days, 102,000. But if you stayed fully invested, that $10,000 investment 30 years ago today would be worth $224,278. I mean, at the end of last year. So that's what we say is take the emotions out of it. A lot of our job, a lot of times, is to play the emotional counselor, and I'm okay with that role. I've learned it to do that because money is very, very important to people. You got your faith, family, and finances are the three most important things to a lot of people, and the finances touches all the other ones. I can tell you, and it's very, very important. I've been on the side where I woke up in the middle of the night thinking about a bill or how am I going to pay this or do that. I came from nothing. I mean, I've been there, I've done that. So again, but goals are goals. And I think that when you come in and you talk them out with a third party or another person outside of yourself or your family, it really helps. It's just kind of like getting a different perspective. And it may be clarification too. So we can come down to the let's see here. Yeah, this strategy here, meet Margie. So here's a typical growth of a $250 monthly systematic investment. And this is into their fund that they're talking about, the market total return fund. So this is showing where $250 a month since 1978 went into this account, went into this account, went into this account, uh, moved to cash. And then this is the other one showing where it was stayed invested and what that looked like over time. Again, it's another look to see um, what that looks like. You look comparing 197,000 to 468. Again, this is just one piece of an investment portfolio. So you can build wealth really good if you got time on your side. I know it's tougher the older you get, but don't let that discourage you if you're later on. every dollar matters when it comes to retirement. That's what I tell everybody, because it does. Let's come on down to, let's see, let's get past that one. That. We can look at the other scenario here. This is where, so Margie approaches retirement. This is the second slide there with the 0 to 339. She and Carol discuss how to transition her retirement plan from accumulation phase into distribution. So this is another thing. If you are getting ready to retire, you're looking at that phase. It's very, very important to talk with a financial professional, because you're basically turning your savings into a salary. So, and that's a hard thing. It's not just, okay, we'll just do this and we'll start taking a certain number, because what's that number look like? Should we just go all to cash? No, we still need it growing. But do you want to take, you have to factor in your risk. You have to factor in what are your expenses, what are your needs, what are your one-time needs. Again, I can't stress enough, planning is the key to what we do. And a true financial professional, not just a person that's selling and buying stocks for somebody, planning should be at the heart of what they're talking about in big picture. So again, just showing staying invested. Again, if we've kind of run through the theme again and again throughout this, is the key to doing that. Again, that's where we want to try to help people stay focused in, is stay invested. Don't pull out when there's a downturn in the markets. Matter of fact, just double up, do more if you can. But again, talk to your circle, your people, financial professionals, myself, or whoever that may be, and let us work that with you. Robbie, myself here at Pinnacle, we're very, very happy to help you guys any way we can. Again, so this really kind of comes to the end of the overall presentation today.